Greetings to one and all. You are listening to MMJC podcast. In today's edition of MMJC podcast, we shall be discussing with you about two consultation papers pertaining to SEBI ICDR regulations released by SEBI and a settlement order in the matter of Paytm, that is 197 communications. So, the first consultation paper will be explained to you by my colleague.
Hello everyone. So SEBI has issued a consultation paper on rationalization of placement document for qualified institutional placement. Now why SEBI wants this change is generally the QIP is made by the listed companies to qualified institutional buyers. The listed companies already make extensive periodic disclosures via stock exchanges under LODR regulations. Also, the QIP are targeted at QIBs, that is qualified institutional buyers, who are sophisticated investors and they have all the means to analyze the financials and condition of the company. So to avoid the duplication and speed up the fundraising process and to avoid the bulkiness of the QIP document, SEBI wanted, SEBI wanted to uh, align the QIP document standards with recent rationalization in rights issue and preferential issue. So what is changing? SEBI proposed to do away with some non-critical sections that is managed, such as management discussions. SEBI is also proposing to condense the financial information of the company and to summarize it with the stock exchange references. SEBI proposes that to specify only material risk factors and legal cases and align the structure with IPO and rights issue document. So basically, SEBI is proposing to add the information which is very important in the document.
Okay. So next consultation paper is about amendment to Regulation 7, Subregulation 1, Clause C of ICDR regulations, which talks about compulsory dematerialization of specified securities held by selected shareholders before going for IPO. So till date, SEBI has taken multiple efforts for promoting, facilitating dematerialization of securities before IPO. However, it is observed that there are many shareholders which still hold shares, securities in physical form, sorry, and which creates a lot of inefficiency and non-compliances post IPO. To avoid this, the SEBI has proposed that now onwards, the selected group of shareholders, which includes promoter group, directors, key managerial personnel, SMP, employees of the company, uh, selling shareholders, qualified institutional buyers, and non-systematically important NBFCs, registered stockbrokers, etc., shall be required to hold all their specified securities in dematerialized form only. Only after their securities are dematerialized, the company can go ahead for IPO.
Yes. The next part is MMJC updates about the orders. So there is a settlement order in the matter of 197 Communications Limited, which is a parent company of Paytm. So you all know that Paytm is under scrutiny by the regulator. The allegations made against the company and Vijay Shekhar Sharma are that the Vijay Shekhar Sharma misrepresented as non-promoter before IPO. The financial results of the financial year 2020-2021, Vijay Shankar Sharma was listed as a promoter, but just before the IPO, he declassified himself as a promoter and then he influenced ESOP grants to himself and his brother Ajay Shankar Sharma. While declassifying himself as a promoter, he transferred his shares to a trust where his family members were beneficiaries. So indirectly, he held control over the company, which was not disclosed in the IPO document. So the IPO document had incorrect disclosures. After SEBI issued a show cause notice, all three notice that is Paytm, Vijay Shekhar Sharma and Ajay Shekhar Sharma filed for settlement, and the settlement was granted upon the settlement terms as follows. That is, Paytm, the company Paytm and Vijay Shekhar Sharma had to pay 1.1 crore settlement. The company has also cancelled Vijay Shekhar Sharma and Ajay Shekhar Sharma's ESOP. And Ajay Shekhar Sharma also has to pay 57 lakh rupees as a settlement. Also, the 35.86 lakh rupees amount which was acquired by selling shareholders were disgorged, and all the ESOPs were cancelled.
So the next update pertains to the compliance due dates falling in the month of May. So the first due date pertains to Form Pass 6. This form is filed half yearly, and since the half year has ended on March 31st, then from the end 60 days from the end of half year, that will come to 30th May. So the due date for this form will be 30th May. The next due date pertains to Form 11 for LLPs. The LLPs, that is limited liability partnerships, are required to file their annual returns in Form 11 again within 60 days from the end of financial year. So as the financial year has ended on 31st March, the form has to be filed by 30th May. Then the next due date comes from SEBI LODR regulations. The listed companies are required to submit their financial statements, annual financial statements, till within 60 days to the stock exchange. So the again till 30th May, the company has to approve its financial statements. Board has to approve, and then it has to be sent to stock exchange. And one more timeline in this is that the integrated financial statements have to be uploaded by the company on the website of the stock exchange on the same day on which the board meeting was concluded. So that's all in this edition of MMJC podcast. Thank you for listening to us, and please feel free to write to us about your feedback.